Welcome back to CMG Aerospace Forex Traders. This is an intermediate class for Candlestick Patterns. We have done a number of videos, so thank you very much for sticking with us. We are on trading the pin bar candlestick with the trend. So the recent one, we did a short video, in fact, a short lesson on the top-down analysis, and then from there we will continue to the pin bar trading strategies, right? So this very episode is trading the pin bar candlestick with the trend, right? So let's continue. Now, if you are a beginner trader, right, I highly recommend you to stick with the trend, right? Because pin bars that occur in trending markets offer good trading opportunities with high risk to reward ratio, to high risk to reward ratio, right? I said earlier that I will be explaining to you more about what is risk to reward ratio, right? So we are not there yet. So I don't want to go ahead of us. You may get confused. So just let's do it sequentially, step by step, and I think you are going to appreciate this series. So now we are going to learn the pin bars with the trend. You stick to the trend. If it's buying, if the movement is uptrend, you buy. If it is downward, you sell. You don't do counter trading, right? Because you are an amateur. So you just stick to this. Now, when you master trading with the trend, you can then move to trade range bound markets or even counter trends. That is it. So now we are not there yet, according to this series. This strategy is simple. You start by identifying a clear uptrend or downtrend, and you wait for a pin bar to occur after a pullback to support or resistance level. So this is the main strategy here. It's as simple as ABC, right? Simple as that. You identify if a trend is uptrend or downtrend, right? And then the second thing is you wait for a pin bar to actually form at this level, a pin bar to occur at this level, or to wait for a pullback to this very resistance or support level. Then you enter, boom, you move. It's as simple as that. And then people stick to this very simple strategy. You don't need your strategies or your chart doesn't need to be what? In fact, they don't need to be too complex, because sophistication can actually be your doom. Keep it simple. I'll repeat, I'll continue to say this thing. Keep it simple. You are not doing this, you are not trading to impress anybody. Your charts is not meant to be sent around to impress people. At the end of the day, you just want to be what? Profitable. So you can stick to this. And then you won't even have to bother yourself learning any special strategies online or YouTube and all that. You can keep this one as simple as that. So you identify your clear trend. That is why you're saying a clear trend, either downward or upward. Then you wait for a pin bar to actually form at this level. So it's a matter of what? Confluence. Simple confluence that we are doing here. And then you wait for a pullback to that level. I think in the previous video, we looked at what is a pullback, the impulsive move, and then the corrective move. Right, that is what we did. If you're forgotten about that, you can go back to the previous video. That's what I said. You should always start with us. If you have not done that, this is the first video, please go back and that. That's simple. It's a simple video that you understand, right? So you wait for a pullback and then you do what? You enter. So this is what is happening here. So generally, what we see that the market is what? It's a downtrend. It's moving downwards. Even though it's a smooth one, it's generally moving what? Down, right? You see, this is simple. This is simple. So this could be our trend line, right? The trend line, the slanted line, the slopey one. That is it. And then we can also deal with what? Our resistance and what? Support level, whatever, resistance. Now, bear in mind that for trend lines, they are usually drawn in a trending market, like the name suggests. trend line. So trending market, upward or downward, right? So your trend line, for a trend line, when the prices are moving down or is in the downsell, downtrend, your line that you usually draw is an upward line, a top line, right? Because prices will be moving below it. That's what it means. But when the prices are what? The uptrend, your lines are what? Are beneath it, are beneath the prices. In fact, your line is beneath the prices. So this is how it is. As simple as that. So generally, prices are moving back below it. Prices start from here, it hits here, it gets back, it goes there, it hits here, it gets back, right? So that's what we are saying, that you wait for price, you find a clear move. This is a downtrend, that's one. And the second, you wait for a pullback, right? 1, 2, 3, 4. This is here. This is a pullback. Because trends are going down, it pulls back like this. That's what we call a retracement, right? A retracement or pullback. It pulls back as if it's going to go up. Then when it gets here, you wait for what? A pin bar to actually form. A pin bar to actually form. So if you're going to stick to this very strategy, if a clear pin bar is not formed at this level, what do you have to do? You have to ignore this. You don't have to take this trade. That is as simple as that. So you should be disciplined. You should be disciplined about this. Many a time, there's lack of discipline in this profession. Even though this is your strategy, this is your plan, sometimes you don't really see a clear move, but you are forced to enter the market because of what? Impatience. So if this is your strategy, then you should stick to that. You wait for what? A pullback at this level where a pin bar is actually formed. So when this pin bar forms, this pin bar is what? A bearish one. And we know what a bearish candlestick patterns do, right? We know what they do. So when this is formed, then there's a clear move that's going to come down. And lo and behold, this is what actually happened. There's a massive downward movement. That's what happened here. So obviously, you're going to be in profit. So if you should enter around this place, or better say, even here, if you are being a bit conservative trader, even if you enter after this candlestick, you are still going to make it to this point. The TP being around this point, we are going to make it. The SF could actually be here, not too far. Then you are in. So the figure below shows how this price action signal works if it is traded with a trend. As you can see, the price was rejected from the resistance level, which indicates that the bears are still in charge of the downtrend. Sorry. The formation of the pin bar indicates that the trend of the retracement move. The formation of the pin bar indicates the end of the retracement move and the beginning of an impulsive move at the resistance level, in line with the trend, with the downtrend. This is a higher probability setup because all the following criteria are respected. So you have to make sure that all the factors of your confidence are in line, right? If one fails, don't force it. Just stay away, wait, and until the setup is what? Correct. So let's look at this. The pin bar is well formed, right? The pin bar in the chart that we just looked at was formed correctly. It is in line with the direction of the market, right? And also in line with the direction of the market. The rejection occurred in a major key level, which represents a hot point in the market. And that's what we call what? The resistance level. Of course, it happened there. 3, the risk to reward ratio is good, right? The risk to reward ratio is good and it's worth trading. This point, you decide, right? So at least I think we are using the term often. So let me just give you a glimpse of that. Risk to reward ratio. So let's say you want to enter a trade, right? A position at this level, right? This is your entry point. And then you are targeting what? An upward move. As you want the market to what? You move up, right? You are buying. So your TP would what? Here. Represented with the initial TP. right? Then SL could be around here, right? So what it means is that if the distance from here, from your entry point to the SL means that in case the market doesn't move in the direction that you anticipated, and you start entering into loss, you have what? Position yourself that at least this is the amount of money that you are risking, a small amount of money that you are risking. So let's say in terms of dollar, if you want to risk maybe $2 for this trade, meaning that if the market does not move upward but decide to move in the opposite direction, and you are losing, you should only be in loss of what? $2, right? That is it. That's your what? Your risk. That's your risk. And then if you are to make it, you are to gain, your reward should be like, let's say $6, right? $6. So if we are going to do this in terms of ratio, we are saying that your risk to reward ratio is what? Let's say 1:3. 1:3. That is it. If you do it in terms of ratio, so something like 6 divided by 2, that would be what? 3. That would be 3/1, or better, so if I'm supposed to do it this way, 2/6, that would be 1/3, right? So usually your risk is what? Is a smaller amount, is a smaller figure. So that is why it should be rather be represented this way, right? So 1:3. So you are risking 1 to gain 3. Some also do this to be what? 1:2, right? Basically, people do it 1:2. It depends on you. It depends on your target. How much you want to gain. So under no circumstance should your what? Your risk be more than your reward. So that is what we mean. So this is a brief introduction to what is risk to reward ratio, so that when I start using them or just mentioning them, you won't get too confused. So that is it. We have a better representation study on these things. So stick with me. So that is what we are talking about. So where were we? Okay, I think point 3. The risk to reward ratio is good and it is worth trading. So you make sure that after finding all these things, the last thing that you have to decide is on your risk to reward ratio. You have to be careful. That is decided by you, the trader. Sometimes, even if the market is trending, we can't draw support and resistance levels because prices move in a certain way, which we cannot spot static key levels, right? So I was saying something like, I think previous videos, we said that when you are drawing your trend lines, don't force it to meet some levels where you think the line is not actually touching. You'll be tempted to do that because these lines are straight lines. You can't manipulate them, right? They are drawn straight from the top down or down to the top. They are straight, or in fact, diagonal lines, right? So you can't decide to join them and then decide to move them like this and then go this way and move straight. You can't decide to draw them that way. So they are straight, always straight. You can't manipulate them. So that's what we are saying. Now, and then the book is also saying again that there are many a time that drawing such a line in the market, you will not get it, right? Prices are moving in such a way that you can't actually get a straight line. Even though the prices are generally moving up, prices are moving up like this. Sometimes drawing a straight line like this, you may not get it. So there's a way to go about this. That's what the book is saying, right? Sometimes you cannot draw the straight line easily. So there's a way to do that. So that's what we are going to look at. If you are in this situation, you can use the 21 moving average, which will act as a dynamic support. So the 21 moving average is going to act like a dynamic what? support, dynamic support. Dynamic in the sense that it's not going to be straight, right? The line is no more, the trend line is no more in a straight line, but it can be in what? In a curve, right? In the curve, just tracing what the prices and then going just below them, right? So that is it. Now, I personally, I said something like, I don't use a lot of what indicators. The only indicator that I use is the 50 moving average, right? Beginning, I also tried using the 21 and then the 8 moving averages. They are, in fact, these one are called technical indicators. Among the technical indicators, this is the basic one. That's the only indicator I have on my chart. I don't have any other indicators on my chart. No. I want things to be simple because I know what I want. The moment prices get to that level, I know what will be the next move. So I don't use other complicated, complex indicators. So that's what we're going to use now. Sometimes during the straight line, you cannot find it easy. So use the 21 moving average. There's a way of putting that average onto your chart, your trading view. You look at that. So when you put the 21 onto your chart, that one will act as a support, as a support level. And it is dynamic. Dynamic in the sense that it's not in a straight line, it moves in the curve. So you look at a situation whereby you use the other moving average to indicate the resistance level. So let's stick to the 21 for the dynamic support. And then let's see in the dynamic support and the dynamic resistance in the downward market. We look at that, don't worry. So this is it, right? This is generally, when you open your chart, we said that the first thing you have to look at, if you look at the market structure, is it moving down or up or in the consolidating or in a choppy way? So looking at this is what is in the downtrend, right? It's in the downtrend, smoothly in that downtrend. So that is it. Now drawing our line, you may have some difficulty, even though this is not all that difficult. You can actually draw a straight line here, but we used the 21 moving average as the support and or the resistance. So it means that the 21 could be used as a support and at the same time as a resistance. It's a matter of putting it on your chart. It is done implicitly. It means that you don't have control over this. The moment you go there, you search that 21 moving average, you type and then add it to your chart. It will draw it by itself. It's not like the trend lines, the straight lines that you actually draw it yourself. Like you go and pick it and put it somewhere and then draw it this way. Doing this, I am the one doing this. I am actually drawing this line. But when it comes to the indicators, the technical indicators, you go and choose, and then it will come and then draw it on the chart. So it is not implicitly, meaning you don't have chart control over this. You draw it and then it shows. So when you draw it, when you put it on a chart, after that you realize that, okay, this is used as a support or a resistance. So even per observation, we realize that this is actually at the resistance level, because the price is actually on top of the price is. So it's being used as the resistance type. So that is it. Then after looking at that, we are still not forgotten about the fact that we are doing trading with the trend, right? With our factors. So you find the general movement, then you draw your resistance, whatever. Then you wait for a pullback with the pin bar actually forming there. So after putting the line, that resistance line on it, we realize that there was a pin bar formation here, right? There was a pin bar here. So this pin bar is bearish. So bearish means the market has a higher tendency of what? Moving down. So this is what actually happened. From here, market moves to this level. So let's say we showed here. We showed here, our entry is here. Our SL may be here. And our TP could actually be here. Look at this level. That would be a good sum of what? Dollars. So that is it. That is one type of what? The trading. This is what? Trading with a trend, specifically with pin bars. I can also draw your attention to the fact that even if you have not forgotten about the other patterns, this, considering these three candles, is what? It's an evening star. An evening star is a bearish candlestick pattern, meaning that when they form at the resistance level, what actually happens is what? It's a downtrend. So that is it. So the pattern, we have a number of the patterns. Some are bullish, some are bearish. So you just have to look at this. It's as simple as that. So with this description, I think reading will be easier for us. Now, as you can see in the chart above, the market was trending down. Using the 21 moving averages helps us to identify dynamic resistance levels and higher probability pin bar setups. See another example. Let's see another example. Now, this is what? An upward. And I told you the upward trend, this is an upward trend. And I told you that for the upward trend, the lines drawn is a support line, and the support line is at the bottom of the prices, below the prices, if you remember, right? For upward, the line is drawn below, and for the downtrend, the line is drawn above it. So now drawing a smooth line, I may not get the prices well, touching all of them, right? So we use the what? The dynamic support level to do that, right? So it is 21, the moving average. So as we go up, down, getting to the down here, there was a pullback from here to this level. And this pullback ended on what? On a pin bar, a hammer type. So this gives us what? A good what? Decision to actually what? Buy along the upward trend. This is as simple as that. Now, the 4-hour chart above illustrates how the 21 moving average would help us find key supports in the market. When prices approach the moving average, the buying pressure takes place in the market, and the price goes up. The pin bar signal is clear on the charts, right? Because the trend is bullish. The price action setup has a bullish anatomy as well. And the rejection from the 21 moving average is a confirmation signal to buy the market. It's as simple as that. So let us look at what the tactics, right? So okay, so I think, don't worry, I wanted us to end this video, but I think we can continue with that. Now, tactics is simply what? Your style of what? Trading. The style for that particular thing. The style of trading a particular pin bar or whatever. Now, when we identify the trend, whether upward or downtrend, and the levels, whether support or resistance, we find a pin bar near this level. And we find it, wait, let me read it well. This book is some way. When we identify the trend, whether upward or downward, and the level, which is the support or resistance, and we find, in fact, it's a continuous thing, and we find a pin bar near these levels in line with the direction of the trend. The second step is what? Know how to enter the market based on what? This candlestick pattern. So after identifying all this, you have to know how to enter. I think we are still continuing with that. I think this is no new thing. It's not a new thing at all. It's the same thing that we are doing. According to my experience, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy, the market conditions, and your money management strategy, right? That is it. Now, the aggressive the aggressive entry option. That's, I told you earlier that we have aggressive trader and we have the conservative or trader. The aggressive is the one when they see a setup, when their setup is ready, they don't wait for any other confluence, right? It means that their confluence may be a little. Their factors for confluence may be a little, not too many of that. And then for the conservative, they have to actually wait, adding more to their confluence before they can actually enter a position. So they wait. So the aggressive see a signal and then they don't wait, they just enter sharply. So this method consists of entering the market immediately after the pin bar closes without waiting for confirmation, right? Without waiting for confirmation. The moment they see the pin bar formation, boom, they enter. This strategy will help you catch the move from the beginning because sometimes the price goes higher after the close of the pin bar. And if you are not in the market, the trade will leave without you, right? So if you are a conservative trader, in fact, I've touched on this already. So conservative trader will have to wait for some time before they actually enter. Aggressive will see it, and then enter fast. So this is what happens here. The market is generally moving down, right? It's actually moving down generally. And this one forms here, right? Now, what we have learned so far was the conservative style. That when you see an downtrend, you wait for a pullback, and then you enter. But here, you realize that here it moves this way, moves here, moves, right? There's no pullback. At this point, there's no pullback, but we see what? A pin bar, the bearish type forming, right? So it means that if you are going to do the conservative type, you should have actually waited for this price to actually get back to this level, right, before entering. But this trader saw this, candlestick formation, and then entered, boom. And then luckily enough, the price actually moved in that sense, even though it drew back, it didn't go upward, but it came back to this point. So this is an aggressive trader, right? The conservative type waits for the price to come back to this level, like we were saying. But the aggressive trader will not wait. You see it, and then boom, they enter, and then they go their way. As simple as that. Now, the chart above shows how an aggressive entry could help you to execute your trade in the right time without being left by the market. And as you see, we took this trade because we had three important elements. There was a trend. The market was trending down. In this case, we look for selling opportunities. The level in this chart, we had a support level that becomes resistance, right? We had a support. Initially, the price was moving this way. So meaning that this one was actually a support, right? Moving down. It got here. Price was rejected. It got here again. Now it couldn't. So now this support has been broken. It now becomes what? A resistance at the top. So that's what it means. Now, the signal, a clear pin bar was formed after the retracement back to the resistance level, right? We said that here there was a quite small retracement, but the trader didn't wait for this retracement on this, and then what? They entered. That's that. So whatever confluence that we did, the confluence were there. Now, when you have these three elements in the market, you just place your trade after the close of the pin bar, right? After the close of the pin bar, and your stop loss above the long tail. Your profit target will be the next support level in case of a downtrend. So here, look at where you place what? The stop loss. Just above the what? That pin bar, right? And then here you can actually place whatever you want to put your TP. It depends on how long you want to be in the trade. So there is no specific unless your risk to reward ratio according to your trading plan is 1:2 or 1:3 or whatever. It depends on you. Now, these three elements are quite enough for you to find high probability entries in the market. Let's move to the conservative. In fact, I've talked a lot about this. I'm not going to explain again. The conservative entry option. This strategy consists of entering the market after 50% of the range bar retracement, right? So the pin bar is what we are talking about, the range bar, whatever. So after 50% of that, this is the whole length, right? So if the resistance or support line cuts in the middle of that pin bar, then we enter. That's what it means. It's as simple as that. So they wait for that resistance or the support to cut the middle of that thing, and then the middle of that pin bar, and then move away. It's as simple as that. This strategy sometimes will work, and it gives you more than 5-to-1 risk to reward ratio. And sometimes the market will leave without you, right? It's conservative in the sense that you want to be what? your risk to reward ratio is very tight. That's what it means. You don't want any misfortune, any bad market, any bad entry. So you are very patient. You wait for it to see a clear, to be more convinced. So that's why you wait for it to actually cut to the middle of what? That pin bar. So that is what it means. And then many a time, it's very profitable. It's very profitable in the sense that many a time you will not lose. So if you compare risks, if you compare this, the conservative to the aggressive one, the conservative is profitable in the sense that your money is well managed. The risk is very low. So that is it. So let's have a look at this. A general downtrend. A general downtrend, right? If I should draw my line, that is what it is, right? And then we wait for the line to cut the middle of what? The pin bar. Look at this pin bar. This is the pin bar, right? This is the pin bar. So we enter after the middle of what? That pin bar. You enter after the middle of that pin bar, and that is 50% of that. Then you go your way. Now, illustration above gives us an idea about the power of conservative entries. As you can see, this entry method helps us decrease our risk and increase our rewards. The trade above has more than 5-to-1 risk reward ratio, right? One trade like this every month is quite enough to generate a decent income, right? Very conservative. That means your trading, your positions are very little. You don't do over trading. You also look at this term. Over trading can be detrimental. Trading too much, entering positions all the time, without patience, without actually looking at your confluence. Some can even enter about 200 trades within a month. And that is over trading on one particular account. They can enter more than 200 trades. And that is too much. According to professionals, over trading is very detrimental, right? Very bad. Can be a bad influence on your trading account. So that is it. Another example. This is what? An uptrend, right? And a general uptrend. Let me move this way. So look at the line. This is what actually happened. It moves back. There was a pullback to this level a bit, not too much of a pullback. The aggressive, the conservative just wait for it, right? So it goes here, it moves back. The aggressive could have what? Just enter from here. They don't wait for this retracement. They will enter from here and then they will go. But the aggressive will wait for it to come and then cut the middle of what? The pin bar, 50% of that. So 50% pin bar retracement entry. We have a stop loss just below that. And then we move. So now the support now becomes what? The resistance. Right? I think in fact the resistance rather becomes support. So Sorry, but I told you I will make corrections as we go. This is actually resistance, because starting from here, this will be a resistance, right? So if this one crosses over and comes to this point, now this rather becomes what? Support, and then we move up. So that is it. One of the drawbacks, it means the downside of this entry. So that means this particular strategy has a downside, a negative what aspect of it. Even though it has a good risk to reward ratio, can be very profitable, yet it can also do what? It can also cause some losses. So one of the drawbacks of this entry option is that the market sometimes doesn't retrace to 50% of the range bar, meaning of the pin bar, which will make you feel frustrated because the market will move to the profit target without you, right? So sometimes, it's not all the time that price will move this way, like this, and retrace to this point, to the 50% of this before you continue. Sometimes it moves to this point and it will not come to this level, it will just continue. And that will be in the advantage of what? The aggressive trader, right? It will never come here. Many a time, I think my colleagues sometimes have this issue, right? They'll be waiting for a pullback and the market will never come back to their level. It will continue that way. So that is, so sometimes I can be aggressive trader and then conservative trader. It depends on my factors of what? Confluence. So it depends, right? I'm not a one-way trader. So that is it. It depends on what you are seeing. Right? Now, there is no wrong or right entry option, right? Both work great, right? You can be either of them and you'll be profitable because you're not always going to win in this market. So that is what it means. But with screen time and experience, you'll be able to decide whether to trade aggressively or conservatively. So thank God whatever I said is here. So I'm not a one-way trader. It depends on what I'm seeing, right? It depends on what I'm seeing. Then I can move in that sense. So that is it. So we will end here and I will continue in the next video. You don't want to spend too much time on one episode. So thank you very much for watching. Please see you in the next video. Like and subscribe to our channel, and then we provide private lessons. You can get back to us and then we'll be in touch. Thank you very much for watching. Bye.